Hi, everyone. Welcome to Be Different for Success. Today, we'll be talking about investment strategies to learn before trading. The best thing about investment strategies is that they're flexible. If you choose one and it doesn't suit your risk tolerance or schedule, you can certainly make changes. Here we look at 4 common investment strategies that suit most investors. By taking the time to understand the characteristics of each, you will be in a better position to choose one that's right for you. Before you begin to research your investment strategy, it's important to gather some basic information about your financial situation. Ask yourself these key questions. What is my current financial situation? What is my cost of living, including monthly expenses and debts? How much can I afford to invest, both initially and on an ongoing basis? Even though you don't need a lot of money to get started, you shouldn't get started if you can't afford to do so. If you have a lot of debts or other obligations, consider the impact that investing will have on your situation before you start putting money aside. Make sure you can afford to invest before you actually start putting money away. Next, set your goals and figure out what your risk tolerance is. This is normally determined by several key factors, including your age, income, and how long you have until you retire. Technically, the younger you are, the higher risk you can take. The higher the risk you take means a higher return. Lower risk means the gains won't be realized as quickly. But keep in mind, high-risk investments also mean there's a greater potential for losses as well. Learn the basics. It's a good idea to have basic understanding of what you're getting into, so you're not investing blindly. Ask questions. Seek out relevant information, and read to learn about some of the key strategies out there. Strategy number 1. Value investing. Value investors are bargain shoppers. They seek stocks they believe are undervalued. They look for stocks with prices that don't fully reflect the intrinsic value of the security. Value investing is predicated in part on the idea that some degree of irrationality exists in the market. This irrationality, in theory, presents opportunities to get a stock at a discounted price and make money from it. It's not necessary for value investors to comb through volumes of financial data to find deals. Thousands of value mutual funds give investors the chance to own a basket of stocks thought to be undervalued. For those who don't have time to perform exhaustive research, the price-earnings ratio has become the primary tool for quickly identifying undervalued or cheap stocks. This is a single number that comes from dividing a stock share price by its earning per share. Value investors seek companies with a low price-earnings ratio. While using the price earnings is a good start, some experts warn this measurement alone is not enough to make the strategy work. Research published in the Financial Analyst Journal determined that investors are often lured by low price-earnings ratio stocks based on temporarily inflated accounting numbers. Anyway, as discussed above, investors can change strategies anytime, but doing so can be costly. Many investors give up on the strategy after a few poor performing years. But if you are a true value investor, you don't need anyone to convince you that you need to stay in it for the long run. This strategy is designed around the idea that one should buy businesses, not stocks. That means the investor must consider the big picture, not a temporary knockout performance. People often cite legendary investor Warren Buffett as the epitome of a value investor. He does his homework, sometimes for years, but when he's ready, he goes all in and is committed for the long term. The message here is that value investing can work so long as the investor is in it for the long term and is prepared to apply some serious effort and research to their stock selection. Investors who are willing to put in the work and stick around stand to gain. Strategy number 2. Growth investing. Growth investors want investments that offer strong upside potential when it comes to the future earnings of stocks. It could be said that a growth investor is often looking for the next big thing. Growth investing, however, is not a reckless embrace of speculative investing. Rather, it involves evaluating a stock's current health as well as its potential to grow. A growth investor considers the prospects of the industry in which the stock thrives. There must be evidence of a widespread and robust appetite for the company's services or products if it's going to grow. Simply put, a growth stock should be growing. The company should have a consistent trend of strong earnings and revenue signifying a capacity to deliver on growth expectations. If a company is in growth mode, it often needs capital to sustain its expansion. This doesn't leave much cash left for dividend payments. In fact, a drawback to growth investing is a lack of dividends. Does growth investing work? As the research above indicates, value investing tends to outperform growth investing over the long term. These findings don't mean a growth investor can't profit from the strategy. It merely means a growth strategy doesn't usually generate the level of returns seen with value investing. While growth investing underperforms value investing, especially over long time periods, it is also true that there are sub-periods where growth investing dominates. The challenge, of course, is determining when these sub-periods will occur. Strategy number 3. Momentum investing. Momentum investors ride the wave. They believe winners keep winning and losers keep losing. They look to buy stocks experiencing an uptrend. Because they believe losers continue to drop, they may choose to short sell those securities. But short selling is an exceedingly risky practice. More on that later. Think of momentum investors as technical analysts. This means that they use a strictly data-driven approach to trading and look for patterns in stock prices to guide their purchasing decisions. In essence, momentum investors act in defiance of the efficient market hypothesis. As mentioned earlier, aggressive momentum traders may also use short selling as a way to boost their returns. This technique allows an investor to profit from a drop in an asset's price. Does it work? Simulated portfolios that put a theoretical momentum investing strategy to work actually add remarkable value in most time periods and in most asset classes. However, when used in a real-world scenario, the results are poor. Why? In 2 words, trading costs. All of that buying and selling stirs up a lot of brokerage and commission fees. Strategy number 4. Dollar cost averaging. Dollar cost averaging, DCA, is the practice of making regular investments in the market over time and is not mutually exclusive to the other methods described above. Rather, it is a means of executing whatever strategy you choose. With DCA, for example, you may choose to put $300 in an investment account every month. This disciplined approach becomes particularly powerful when you use automated features that invest for you. It's easy to commit to a plan when the process requires almost no oversight. The benefit of the DCA strategy is that it avoids the painful and ill-fated strategy of market timing. Even seasoned investors occasionally feel the temptation to buy when they think prices are low, only to discover they have a longer way to drop. When investments happen in regular increments, the investor captures prices at all levels from high to low. These periodic investments effectively lower the average per-share cost of the purchases. Putting DCA to work means deciding on 3 parameters: the total sum to be invested, the window of time during which the investments will be made, the frequency of purchases. Dollar cost averaging is a wide choice for most investors. It keeps you committed to saving while reducing the level of risk and the effects of volatility. But for those in the position to invest a lump sum, DCA may not be the best approach. On average, we find that a lump sum investment approach has outperformed a DCA approach approximately 2/3 of the time, even when results are adjusted for higher volatility of a stock portfolio versus cash investments. But most investors are not in a position to make a single large investment. Therefore, DCA is appropriate for most. Regular automated investments prevents spontaneous, illogical behavior. Final thoughts. Once you've identified your strategy, there are still a few things you'll need to do before you make the first deposit into your investment account. First, figure out how much money you need to cover your investments. That includes how much you can deposit at first, as well as how much you can continue to invest going forward. You'll then need to decide the best way for you to invest. Investing is a roller coaster. So keep your emotions at bay. It may seem amazing when your investments are making money, but when you take a loss, it may be difficult to handle. That's why it's important to take a step back. Take your emotions out of the equation and review your investments. The decision to choose a strategy is more important than the strategy itself. Indeed, any of these strategies can generate a significant return as long as the investor makes a choice and commits to it. The reason it's important to choose is that the sooner you start, the greater the effects of compounding. Remember, don't focus exclusively on annual returns when choosing a strategy. Engage the approach that suits your schedule and risk tolerance. Ignoring these aspects can lead to a high abandon rate and frequently changed strategies. And as discussed above, numerous changes generate costs that eat away at your annual rate of return. Thanks for watching this video. I hope you liked it. Please click the thumbs up and write your personal tips in the comments below. Thank you for your support. And don't forget to subscribe to the channel if you want to hear more from us. See you in the next video.